Hello and welcome to Money Markets and More with me, Dominic Frisby, coming to you today from Ecuador and the Quilotoa volcano, which is a volcano called Quilotoa with this massive great lake in it, which you can see behind me. And I've just done this walk. We've walked the entire cliff top around the crater, and it was only about 7 kilometres, 4 or 5 miles, but it was one of the hardest walks I've ever done in my life. It took me about 4 hours, and I walked it with my friend over here, Elias. Dike ciao, Elias. Who's a veteran of the region, and I accidentally cut myself off there. Anyway, as part of my trip around the world, I've been trying to do my walk and talks from the most exotic locations possible, and I think that's pretty good. So today we're going to consider oil and gas once again, and while the oil and gas prices haven't done a great deal for the last 6 months, they've been up a bit, down a bit, then sideways, the associated companies have done very well, the producers, the service companies and so on. I'm going down a very steep hill here. Maybe I shouldn't attempt this hill while I'm doing a walk and talk. And it's because many years of belt tightening and bear market are now paying off. However, I would suggest we are not yet at the point of excess and decadence that marks the end of a cycle, when you see all the crazy mergers, the acquisitions, the insane valuations, the bacchanalian behaviour from the executive classes. So I venture that today, as last week, there is still plenty of gas left in the tank of this bull market. And with that in mind, I wanted to share a few charts with you today that give you an idea of what is possible. And the first of them shows the ratio between energy stocks and the rest of the market. Indeed, without energy stocks, there wouldn't be a rest of the market. A simple point that many, especially those who make policy, seem oblivious to. The world we live in today and the economic benefits we enjoy relative to our ancestors have been made possible by fossil fuel. So here is the energy sector relative to the S&P 500, and the higher that chart goes, the bigger the relative market cap of energy stocks relative to the rest of the market. And you can see that even with the rally we've seen in energy companies since 2020, on a relative basis, energy companies are, give or take, where they were at the turn of the century, when oil itself was around $10 a barrel. And that secular bull market that went all the way until 2008 was only just getting started. You can also see that we're in an uptrend. Energy stocks are increasing in value while the broader S&P is flat or falling. It's also worth noting that the relative market cap was almost 3 times as large in mid-2008 when oil went to $147 a barrel. The inference is that the bull market has a lot further to run. Now next we're going to consider the ratio between oil, West Texas Intermediate, and the S&P 500. And you would expect this chart to trend lower over time because oil production and extraction techniques should improve over time while broader economies and the companies that operate in the broader economy tend to grow. Nevertheless, here's the chart, and we are below the levels we were in the early part of the century. And you can see how high that ratio went in 2008 and how low it went in the corona panic of 2020 when oil futures somehow went into negative territory. Relative to the S&P 500, oil is roughly where it was 3 or 5 years ago. I'd say it's pretty much sitting on its 3 or 5 year average. And it's a lot cheaper than it was throughout the entire 2000 to 2014 timeframe. So even with the gains of the last 2 years, oil does not look expensive relative to the S&P 500. It is at the cheaper end of the range. And that is another sign that there is more gas left in the tank of this bull market. Now we're going to look at oil relative to gold, and these two, as hard commodities, tend to trade in a much tighter range over time. But my observation again is that the that it's in the low to the middle of the 20-year range. It's not at one of those points of extremity whereby you might consider rolling out of one and into the other. For sure, we're nothing like we were when oil went to $147 in 2008. In fact, we're below where we were for most of the noughties. So on the basis of that chart, oil is still probably the cheaper of the two. Now, as regular readers will vouch, oil is a drum I've been beating since 2016 when it was $25 or so. I said it was the trade of the lustrum. A lustrum is a 5-year period. It's a very useful and underused word, I'd say. And that lustrum is now becoming a decade. And we continue to beat the drum on oil, gas, coal and the related companies. Fossil fuel demand will continue to grow until at least 2030. The IEA has forecast that, 2040 in the case of natural gas. That means it's not just enough to maintain current production levels, they need to increase. Yet there have been 7 or 8 years of underinvestment leading to today's shortages, partly because of ESG deterring investment, partly because so much capital has gone into green energy related companies instead, and partly just because of the excesses of the previous bull market. They still needed to be purged. I'm going up a hill and I'm at 4,000 metres of altitude, so I get out of breath. The bull market conditions are still good, and longer term I think fossil fuel stocks go higher. I'm a big believer in narratives within markets, and the fossil fuel story is only slowly starting to change. Many are realising just how important they are and what they've made possible. Indeed, there is a strong moral case for them. Not against them, but for them. But the narrative is not yet at end of cycle levels. When people start talking about peak oil again, that's the sort of thing you want to be looking out for. That is that the need for alternative energy sources is not because fossil fuels are bad, but because we have consumed them all. I don't know what the end of bull market narratives will be. That's a story that's yet to be told. I'm so out of breath. But if legislators and subsidisers start abandoning electric vehicle initiatives because the ultimate source of the electricity remains the burning of fossil fuels, and it's really quite inefficient, never mind hypocritical, I guess that's one possible scenario. So my advice is hold on to your positions, enjoy the ride, and the bull market is still on. Thanks very much for watching. Please subscribe to my channel, please subscribe to my Substack. I'll put links in all the descriptions. And if you're in London, December the 16th, I'm doing a gig with my band, the Gilets Jaunes, with Comedy Unleashed. It's a big Christmas knees up in Camden. Come along to that, should be fun. And apart from that, have a lovely day. And I hope, where am I going to be next? Actually, I'm headed home pretty soon. So this might be the last exotic location for now. Anyway, enjoy the view. The view of Elias. There we go. And here I'll go and give you a last final view of this amazing place. Here we go. Pretty special.